Good day, fellows. My name is Ethan, and I am your finance fellow. And today, I'm going to be answering an audience member's question. So this is a small business owner that I have worked with in the past, and we work on a couple things here and there. And he asked me an interesting question. He said, 401ks versus bonds. Which one should I choose? And I said, well, that's an interesting question because they're not similar in how they're structured. Because a 401k is an investment account. In the terminology, 401k is an investment account. A bond is an investment, right? So an investment account holds investments. Somewhere along the line, people have got really confused with the terminology of what a 401k is versus what other fixed income / deferred tax deferred income is. So let's talk briefly about bonds. Bonds are set at a certain rate. Let's say I have a bond. I'm going to loan XYZ company $1,000. And this is going to be through a bond. And that XYZ company is going to pay me $50 or 5% for 5 years. So that bond that I'm loaning the company, I'm giving the company $1,000. I'm going to get back from that company $50 for 5 years. And then they're going to pay me back the $1,000 that I originally gave them. Okay? That is how bonds are structured. Now, the way that bonds are taxed is ordinary income tax rates. Now, there's different types of taxing structures, different types of how taxes are pulled and how they're put together. There's alternative minimum tax, blah, 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 blah. It's really complicated, which is why I always tell people that we're going to start having a lot of moving parts in their investments. And you really should look at hiring accountants and an enrolled agent, a CPA, someone who's competent when it comes to tax matters. But in regard to how bonds are taxed, it's ordinary income tax rates. It's the same taxable income rate you pay on the wages you earn. And that's not just strictly bonds, that is interest in general. If you receive interest from a savings account, then you are going to be taxed at ordinary income tax rates for that interest amount. So if you're paying taxes on your income and you're paying 20%, then that interest is also going to be taxed at 20%. Does that make sense? I hope it's pretty easy to follow there. Now, why do people confuse bonds and 401ks? Well, I know of bonds in the past. I don't know what they're called or exact terminology is with them, but I've heard of bonds that pay out at the end of the term or at the end of the bond lifetime. So there are a few occasions where these bonds can pay out as a lump sum in the end, and then you pay your taxes then. 401ks are very similar. 401ks are tax deferred, so you put money in, and then you don't have to pay any tax on any of the growth from zero to whatever amount you have until that money is pulled out of the account. Okay? So 401ks are a great investment account, but they are not a good investment because 401ks only hold the investment. 401ks are structured in a way that they offer tax-deferred, tax-free, and after-tax growth. There are different components to all three. We're just going to focus on traditional because that's what they're talking about when they ask for bonds versus 401ks. So the 401k, traditional, you put money in. I make $100,000 a year, and I'm putting $20,000 in my 401k. It's an amazing number. 20% is an incredible number. But the federal government says, okay, so you made $100,000, but you put $20,000 in a 401k. So we're actually going to take that $20,000 and subtract it from $100,000. So you have taxable income for income tax purposes of $80,000. That is effectively the government saying, hey, we're giving you if you're paying 20% taxes, we're giving you a 20% contribution to your 401k because we're letting you, not pay the taxes on the money that you made. We're saying, hey, we see that you did it, but we're not looking at it. We're looking away. It's the best way to legally hide money from the government whenever you have great years on your business, if you're an entrepreneur, or if you just have a really high income year, maybe you're a salesperson and you make a large commission. If your company offers a 401k, this is a great chance to say, hey, I want to put a bunch of money into my retirement and I want to really sock it away so the government cannot tax it until way later on. And that opens up opportunities for tax planning as well whenever we start talking about retirement. But in this particular case, as you begin to age, the 401k account becomes a staple of putting your fixed income assets into. Now, you should be increasing your Roth IRA. You should be increasing your after-tax assets as well. The 3-bucket strategy that I'm sure you've heard before. But 401ks are great fixed asset or fixed income investment accounts because 401ks, when you pull the money out, it's taxed at ordinary income rates the same as bonds. So why not put our bonds in the 401k account and then let those pay out $50 every single year? Okay. But I don't have to pay taxes on it as already income tax. Eventually, whenever I go to pull that money out, then the 401k is taxed at ordinary income tax rates. And in retirements, when you have Social Security, you have your other investment accounts like your Roth IRA or your Roth account, maybe your Roth 401k, your after-tax component, or your just general brokerage account, you can plan your the taxes you're paying a lot better. By doing that, you can just find better ways to pay a lower tax rate in retirement than you were paying when you were working. And that's the perks of 401ks. So my answer to the associate or the viewer, watcher, audience member is 401ks versus bonds. I love both. Take advantage of the 401k, put your money in the 401k if you're employed, or if you are working as a self-employed, solo 401k are always available. But in most cases, the 401k is a great place to house bonds because they are taxed at the same tax rate. But by being housed in a 401k, you don't have to pay taxes on what you get paid out by the bond every single year. All right, so that was question 1. The next question that I have received probably 3 times now, and I actually found someone on Reddit who was asking a very similar question. They said, at what point should I consider putting money into a 401k traditional account versus putting into a 401k Roth account? So Roth is an incredible vehicle. It is an investment account structure that says, hey, I'm going to pay taxes on the front end. I make $100,000. I'm going to put $20,000 in. I'm still going to pay income taxes on $100,000, the full amount that I got paid on my W-2. And then when I go to pull that money in retirement, I don't have to pay any taxes on it. That's just money. That's how people become liquid millionaires. When they have enough cash or they have enough Roth assets that their entire liquid account is $1 million or greater that they owe no tax on. It's an incredible place to be in. It's when you get to that point, that is how you determine whether you've hit financial independence. When you can look and say, hey, I've got a very large Roth bucket and I see that I have that's going to accumulate or sum up to about, 80% of my retirement. Congratulations. You're very likely at your point of financial independence or very well on your way to financial independence. But the question asked here is 401k traditional, 401k Roth. When do I make the decision to choose the traditional or the Roth? Okay, so let's talk about tax rates. Tax rates are the important decision characteristic here. If I make a very good income, say the upper tax rates, I'm paying, federally, I'm paying 32%. Very high income individual, depending on if they're married, filing single, or if they're head of household. There's very different income levels that can be at that tax rate. But just say I'm paying 32%. 32% is an amazing number to be at for your income. If I put money into a 401k, a traditional 401k, say I max it out well, let's just say I put $20,000 into that 401k. The government has effectively given me 32% of that contribution, because they say, hey, I know that you made this amount of money, and at 32% tax rate, you're seeing, oh man, I could pay 32% taxes on this $20,000, or I pay zero on it by putting it into a 401k. And when I go to retire, my tax rate may be 10%, 12%, maybe something closer to 20%. We don't know where the tax rates are going to go in the future. But we can look at those numbers and say, okay, so if I put my money, my $20,000 that I have, into this 401k account, and I'm being taxed at 32% income tax, the government's effectively giving me a 32% contribution, right? At what point do we make the switch from Roth to traditional? My general consensus on that is, and I tell everybody's different. Everybody has their own unique financial situation. But my general consensus is, if you're paying an income tax rate of above 28%, both federally and state, then you should take that income, or then you should determine which account you want to put it in, leaning more towards traditional until you get to about 32%. Once you hit 32%, I say traditional. Put as much money into that account as possible, because there's no better way to hide money from the government legally. Tax evasion gets you Al Capone. Tax avoidance is highly encouraged. So take advantage of these structures that are available to you, these investment structures. And if you make anything above the 28% income tax level between federal and state, really consider putting money into that traditional IRA. Now, if you make less than that, Roth 401ks, I meant traditional 401k, but Roth 401ks are an incredible vehicle as well. These things you're going to grow tax-free. Yeah, you'll pay taxes on the front end, but you're really not paying a huge portion of your taxable income in on these lower amounts, say 10, 12%. So that's the point, 28% versus 32%. Find where in that 4% gap there's some nuance. Maybe you don't have enough Roth assets to really smooth out that retirement. Maybe you should look at putting in Roth. But after 32%, absolutely put in as much money into that 401k, 403b, 457 as possible. All right, guys. So that's kind of what I've been going with questions. We're going to be doing these probably once a week. I like to get more consistent questions as we grow, and as I get more questions asked, I'll find specific genres or specific types of questions and kind of put them together and sort them out in a way that it's a 401k question episode, or a Roth question episode, or a insert blank small business question episode. So as we begin to grow and we begin to look at these numbers, and as I get more comfortable with the whole recording thing, then we can figure out what would be best, and we can find a more consistent structure. Now, I decided that I was going to create this video and not make a script for it. I'm just going to blabber and, say what I want to say as it came to mind. And it's going to be very unstructured. And I apologize for that. I'm trying to get more comfortable with the camera, but also I'm trying to be better at explaining these accounts, these investment retirement accounts, to clients and customers alike, and the audience. Hey there, guys. Thanks so much for watching the video or listening to the show. I want to make some clarifying points. First and foremost, I am a professional, and I do have a legal obligation to make sure that you get information and use it the best way possible. However, this show is just for general information purposes. Everything that you have going on in your finances, everything you have going on in your life is so specialized. Do not take the information that I provide in my videos as investment advice. Talk to a financial advisor, speak to an accountant, so that you know what's going on with your taxes and your retirement. Everything I say in this video is for informational purposes only.